Hi, everyone. I'm Mike Pacito with I Am Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for watching our May 2026 update, the alt solution for the Model Revolution 7-year anniversary of DBMF. So in May, DBMF hit its 7-year anniversary. Actually, the live track record goes back almost 10 years, as it was previously an SMA before converting to an ETF. Alongside reaching this milestone, we believe the performance success and strong adoption of DBMF because of its Index Plus design and fiduciary friendly approach to this space is distinctive and compelling. So let's go through some anniversary stats. As of the end of May, $3.89 billion in assets, making DBMF the largest strategy in the Morningstar systematic trend category amongst both ETFs and mutual funds. Incepted on May 7, 2019, DBMF is the third oldest managed futures ETF in the space, with annualized returns of over 9% and a return of over 23% in 2022, delivering real uncorrelated performance in a year that saw both the S&P 500 and Bloomberg Ag Index down over 20% each. Less than zero correlation to equities using the S&P 500, providing true diversification benefit as an alternative should, and over 750 basis points of annualized alpha generating performance, all with an 85 basis point expense ratio in the bottom decile of strategies in the Morningstar category. So to sum it up, we believe that DBMF has been disruptive in the best of ways, and we want clients to feel confident about their choice in implementing DBMF into their portfolios. So we want to thank all of our fellow shareholders for partnering with us on this journey and for believing in what we're looking to accomplish for allocators, advisors, and most importantly, investors. Okay, there was the DBMF 7-year commercial. Andrew, with that, let's get to the May update. Over to you.
Thanks, Mike. So on a price basis, we were up about 1.44% in May and are up nearly 11% this year. So both figures are slightly ahead of the performance of the SocGen CTA index and Morningstar category, and we're 800 to 1,000 basis points ahead of each over the past year. So as I said last month, a great start to the year and an even better 12 months. Which brings me to my first bullet point, non-crisis alpha. This is a reference to a common misconception that the CTA, also known as commodity trading advisor community, tends to deliver the best returns during market crises. We're trying to make a more subtle point that CTAs deliver alpha when they are early, contrarian, and right, which can coincide with a market crisis or, like the past year, with big macro moves during a risk-on period. So CTAs are simply an all-weather solution. Now, the second bullet point is about macro ripple effects. It's not an accident that we're up considerably over the past year. We are witnessing history. The AI revolution is in full swing. A reordering of global supply chains is underway, including energy now, and governments are testing the patience of bond market vigilantes. These big shifts, equities decoupling from historical valuation metrics, first gold and crude doubling, global capital flows upsetting supply-demand relationships among asset classes, these are all causing really big price moves. Now, is the hope is that CTAs will pick up on them and generate alpha, as I said, by being early, contrarian, and right. And this is what I referred to in the last bullet point. To help allocators understand the role of CTAs, we need a definition that reflects the role they play in portfolios. And it certainly is not commodity trading advisor or even trend following, both of which sound like you're late and blindly following consensus. So we think the CTA term is useful, though, because so many investors are familiar with it, but instead we believe it should refer to contrarian, tactical alpha. That's why the strategy is almost uniquely valuable in model portfolios when the investment ethos is consensus strategic beta. As Mike mentioned, we celebrated the 7th anniversary of the launch of the fund, and in a month or two, we celebrate the 10th anniversary of the strategy. Now, Mike has already given you the key stats, so I don't need to repeat them. But since our goal was to take a great asset class and make it both better, read higher sharp, and more accessible, read ETF, it's worth highlighting a few stats. Since inception, we've outperformed the flagship hedge funds in the SocGen CTA index by 370 basis points per annum, and the Morningstar peers by over 470 basis points per annum. Our beta equities is slightly better, read lower. Our Sharpe ratio is meaningfully higher, as is our alpha generation. So we hope more and more allocators will recognize the value of this strategy and that we can be a cornerstone allocation within those allocations. Here's our slide on volatility-adjusted positioning. The green bars are the volatility adjusted exposure of our 10 futures contracts at the end of May, and the red dots are positioning at the end of the first quarter. Moving from left to right, we have maintained our crude oil exposure, which we started to add in January, and continue to cut back on the long gold position after the sharp reversal in March. We added slightly to a spread trade between the euro and the yen. As inflation fears have been rekindled, we've maintained a short position in treasuries across the curve. And we've shifted from a big bet on the rotation from US into non-US developed markets into a long equity bias, reflecting, not surprisingly, the unstoppable AI train in the US and elsewhere. And finally, here's our year-to-date contributions to performance. The big moneymaker this year has been that long position in crude oil, which, as I mentioned, we initiated in January. We gave back some gains in crude last month, but it was more than offset by the gains in equities. The long position in emerging markets has generated almost 5% for the portfolio this year, and EFA has recovered after the brutal reversal after the Iran war began. So in general, the best period for CTAs is when there are at least two of the major asset classes are generating gains. So it's nice to see gains distributed at least across commodities and equities so far this year. And with that, back to you, Mike.
Okay, thanks, Andrew. So let's wrap up here with long-term performance numbers for DBMF. Annualized return since inception, including the month that was May 2026, is now 9.35%. That's ahead of the SocGen CTA index by 370 basis points annualized, and it's ahead of the Morningstar systematic trend category average by over 470 basis points, and the long-term outperformance against the traditional diversifier for equities. That would be bonds, as represented by the Bloomberg AG, well intact, DBMF outperforming by over 775 basis points annualized. So thanks everyone for checking out our monthly videos. If you have any suggestions in terms of things you'd like to see added, changes, feedback, or inputs, please let us know. Otherwise, if you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out to send us an email at team@imgp.com.